Welcome on board Seshagiri Rao, the joint MD and Group CFO at JSW Steel, joining in on the show right now. Mr. Rao, good morning. It was a tough quarter for JSW Steel, the lockdown and then the outbreak at the facility. Let's start first with realizations, because a big fall over there because of adverse market and product mix as well. What was the difference in realizations between exports as well as domestic sales, if you could highlight that?
So instead of exports and domestic market, it is not comparable apple to oranges, because when you want to export, you book in advance, maybe 2 months ahead of the actual exports that would take place. So the domestic prices right now cannot be compared with the domestic export realizations of the month. So we have to look at when we have actually booked the export contract. But notwithstanding, there is a difference in the export realization versus domestic realization. The blended NSR sequentially has come down by 12%. So notwithstanding, the costs also have come down by 4%. There was an impact on the margins. That's why the standalone basis, so the EBITDA margins have come down to around 13.5% and 5,100 rupees per ton. But what is more relevant here is in the last quarter, actually the results were 2 months, even though we call it as a quarter. April was a wash. April actually, we could not even recover entire fixed cost. Therefore, if you look at 2 months performance vis-a-vis a quarterly normal performance, I think we did reasonably well in the last quarter. Over and above that, generally we sell our semi-finished product like slabs, billets and blooms, 2 to 4% of our total sales volume. But in the last quarter, it was almost close to 13%. So semis were higher. As you rightly mentioned, geographical mix-wise, the average export mix was 57% in the quarter. These are the two main reasons. Once we have lost a volume of close to 1 million ton, because April we did not work for the full month. Second, the geographical mix, another is product mix. These are the three reasons why I think last quarterly performance than what we desire was lower.
Right. Mr. Rao, so how are domestic realizations trending now during this unlock, and how is the demand looking? If you could just highlight that.
The average realizations or prices in the domestic market have come down in the month of May and June, in line with what has happened globally. But what has happened over the quarter or in the month of July, if you compare the prices of China, where it came down as low as $397 FOB prices, they went up to $480 currently. So the prices really went up close to $80-85 per ton. So as on date, if you compare $480 FOB plus another $20-25 freight. So 500 C&F landed cost of imports, if you compare from China vis-a-vis the domestic prices are at a discount at least to the extent of 5 to 6%. So that is where I think there is a scope for increasing the prices in the local market for the steel.
The June quarter saw 53% of volumes being exported. How much will this come down to in Q2? Also, China has been a big buyer, but as one of its biggest companies struggled with shutdowns, have export order inflows come down?
No, as far as China is concerned, the steel industry is moving completely in a different direction in China relative to global steel industry. Excluding China, if you see first 6 months of the calendar year, the production came down by 14%, whereas in China it went up by 9 million tons. So production in China is going up. Rest of the world, there is a supply side adjustments which are happening in line with the falling demand. That is the scenario. And at the same time, what is also very interesting is that Chinese exports in the first 6 months have come down to 29 million tons as against 35 million tons which they have done in the earlier year. So their exports are coming down. At the same time, their imports are going up. Their imports in the first 6 months of this calendar year was close to 7.5 million ton as against 6 million ton in the previous year. So their imports are going up, their exports are falling. the production is increasing, which clearly indicates that there is a huge amount of domestic demand driven by their stimulus or their infrastructure projects. Their consumption is very strong. That is also getting reflected by way of a surge in the prices in China, steel prices in China. That's why I said over $80 per ton is the improvement in steel prices in China in the last few weeks.
You've given a sales guidance as well for 15 million tons for FY21, of which you've done 2.8 million in Q1. What's been the recovery in domestic demand, and what makes you confident of meeting this kind of target, which demands a growth rate of 12% year on year for the rest of the fiscal year?
No, the way I look at it is out of 15 million ton, if you take out 2.8 million ton already done the quarter one, so we have to do around 12.2 million ton, which we need to do in the balance 9 months. If it is a 12.2 million ton on an average, we have to deliver 4 million ton per quarter. So there were several quarters where JSW delivered 4 million ton of sales, over 4 million ton of production. So that's why I don't think there is a difficulty in terms of achieving our guidance. So the only issue is if domestic consumption does not pick up the way we are all anticipating, then there will continue to be some more exports from our side. But what is encouraging is that in the first 3 months, if you observe, the recovery in the domestic demand, which was only the 9% or 10% of normal, improved close to 50% plus. So that is the kind of improvement in the domestic demand which has happened from April to June. So domestic demand will definitely recover, may not be as a V-shaped recovery, but there will be a gradual recovery. In line with that, we will moderate our exports, and we will be able to achieve our guidance of 15 million ton, which we have indicated.
Let's talk about the plant which you've commissioned in Orissa. What is the status on that?
I think the way we have worked on these mines, where we have secured in the month of February and March 2020, even after impact of big COVID-19, where nothing has happened for almost 1.5 months, we could close everything in the month of June 2020, and we paid all the payments, signed the agreements, and finalized the MDO contracts, and started mining on 1st of July. So we already also started dispatching the iron ore for our plants. So I think it will be a game changer as regards to these 4 mines are concerned. A significant portion of our captive requirements of iron ore for our Dolvi and Salem plants are met from these mines. So that we'll be able to work on to reduce logistics cost, to reduce the mining cost, to reduce the transportation cost. With that, we will be able to really optimize the cost of iron ore for our plants.
You maintained your deadline of completing Dolvi expansion for the second half and Vijayanagar also by Q2 and Q3. Capex will be incurred and debt will be ratcheted up at the end of this fiscal. Also, has the lockdown made any changes on the cash flow?
No, in the quarter one, in spite of EBITDA being lower, only at 1,341 crores, even after spending close to 2,000 crores in Orissa mines, and also spending 1,100 to 1,200 crores in other capex, our debt has gone up by only 1,000 crores of rupees from 31st March 20 to 30th June 2020. So we are very cautious to control the overall leverage and debt. Then this year, the capex guidance which we have given is 9,000 crores. So we will manage within that guidance. We have already spent, including mining capex, around 2,100 crores for the quarter one. So we will spend the balance and complete this capex program of 9,000 crores and expand our capacity by 5 million ton, in addition to expanding capacities of the downstream unit. So next year, I think there is a very big increase in volume because of crude steel production of 5 million ton coming in additionally. The downstream capacity is going up from 5 million ton to 9 million ton. And a lot of other projects of backward integration is getting completed. So next year, I think there is a huge amount of benefit that would come in. So in this year, our objectives are to deliver operationally 16 million ton production and 15 million ton sales, and improve the EBITDA margins. The second is complete all the projects and expand capacity by 5 million ton crude steel and 5 to 9 million ton of downstream. The third is complete all the acquisitions which are where we are a successful bidder. So those acquisitions also we will get it completed in this financial year. So I think next financial year when India starts recovering and steel demand really picks up, I think we are in a far, far better position to meet that growing demand.
Sure. Mr. Rao, also wanted to understand what is the plan with the overseas business units as well, because they've been underperforming. They've posted an EBITDA loss as well in the first quarter, clearly dragging your overall consolidated financials. Could there be a sale on the table?
No, the operating EBITDA in the last quarter, that is Q1 2021, has come down either sequentially or compared year on year. So even though it is at 248 crores, it is lower than what we have posted in the Q4 20. Going forward, we have taken a lot of steps to reduce operating losses and also to contribute from Q3 onwards positively to the EBITDA. That is how we have planned. In the plate and pipe mill of USA, the phase 1 modernization is complete. So the benefit of this modernization will start coming in from Q3 onwards. So the operating losses in the Q2 will come down. From Q3 onwards, it will become positive. In the case of Ohio, we have taken temporary shutdown of the unit until the CapEx program is complete. That CapEx program will get completed in the Q4 2020-21. Then we'll restart the operations in Ohio. So during this period, operating losses will be lower. From Q4 of next year, Q4 of this financial year, Ohio start contributing positively. Similarly, in Italy, we also have focused more on optimizing the product mix. We'll be producing fully the rails and grinding bars. The other products we have reduced. With that, even the Italy unit will start contributing positively from Q3 onwards. That is how we are working on overseas operations to minimize the operating losses and also to work on contributing positively from Q3.
Mr. Rao, thank you so much for taking the time out and speaking with us about your earnings and the look forward. For the markets, we're 0.5% low on the Nifty futures right now. There's Nalco, M&M Finance, ICICI Bank, by the way, is a big drag. It's now at the lows. It's down about a solid 4% right now. And dragging the Nifty further is also HDFC Bank, which is down about 2.25% as we speak, along with SBI. Though on the flip side, it's a bit of a tug of war. Asian Paints holds out. TCS is still holding out. And Reliance has eased off a little bit from the top, but it's still holding out roughly about 1% on the futures. So interesting day in that sense, and a weak market breadth, of course. We're going to take a very quick break, but more on the markets with Hiren Ved from Alchemy Capital after this very quick break.